Well, good morning, Jaginder Rana here. So the topic of the day is climate insurance market in India. Climate insurance market in India. India is the seventh most vulnerable country to climate change, making it highly susceptible to extreme weather events. While the historical rise in temperatures in India has been slightly lower than the global average, projected increase in the future exceeds global rates. In the absence of adaptation measures, extreme river floods and coastal flooding threaten to affect almost 50 million people by the end of the century. Similarly, in the absence of appropriate mitigation policies, a 3 to 10% shrinkage in GDP can be experienced annually due to climate change. So the burden of economic stagnation resulting from catastrophes will disproportionately fall on the urban and rural poor. This delineates the need for hedging mechanism to spread out the climate risk both geographically and interim or you can say intertemporarily. So the need for climate insurance is there. Extreme weather events affect the economy in two stages. The initial damage to human and physical capital and the subsequent loss of productivity due to efforts directed towards construction or reconstruction. So one way to ensure the timely, need-based and transparent disbursement of reconstruction funds is by roping in dedicated climate insurance. Climate insurance can pay out claims to insurers in the event of a natural disaster. So it can act as a crucial climate adaptation strategy by challenging the excess capital of one agent to compensate for the loss of another with an additional cost premium. The 1990 Intergovernmental Panel for Climate Change report was the first to note the importance of the role of private insurance players in mitigating climate-induced natural disasters. So climate insurance has the potential to enhance both mitigation and adaptation. For instance, insurance companies have the resource capacity to make long-term investments in disaster resilience projects, allowing for adaptation. However, when premium becomes a function of the environmental cost of businesses' operations, insurers can influence industry practices. Lower premium and higher coverage for enterprises with a lower carbon footprint can lead the market towards mitigation endeavors. The nature of insurance market intervention can acquire two forms. First, the insurance market can incorporate a climate risk assessment component in all the insurance policies, facilitating flow of funds to green businesses. Second, the private insurance market can play a more proactive role in rolling out climate risk insurance policies for sovereign entities like municipalities, state and national governments to recover from natural disasters. Thus, the market not only serves as a hedging mechanism but also provides a metric of sustainability of business through differentiated premium cost. As far as climate insurance in India is concerned, In India, some of the most climatically vulnerable and hardest hit areas are also the poorest. Communities living in coastal areas and hills belongs to one of the most economically compromised and climatically exposed social group in India. So for instance, India lost over US $3 billion worth of assets due to floods, which amounts to 10% of all the global economic loss due to natural disasters. So the recovery process to recuperate from the damages is often slow and ill-funded. Be devilled with the red tapeism and whimsical fund disbursements, making it a fertile ground for federal and state government conflicts. So studies show that early intervention can have 3.5 times the impact of delayed payments. In this backdrop, the deployment of climate risk insurance can provide for a secure and certain source of reconstruction funds to minimize the post-disaster consequences. It can roll payouts to the government administration of the affected areas, while also conducting the prerequisite checks and scrutinize to ensure that funds meet their ends. So only sub-segment of climate insurance that India's insurance market rolls out is agricultural crop insurance. With 65 crore farmers, most of whom rely on monsoon, vulnerable to unseasonal rains and pest attacks, strategically promoting and effectively implementing crop insurance can have a huge impact on their livelihoods and well-being. Over 55 million Indian farmers have crop insurance under the Pradhan Mantri Fasal Bima Yojana. Nearly 70 lakh farmers have benefited from it in the financial year 2021, with claims worth rupees 87.4 billion, that is US $1.2 billion, transferred to the beneficiaries. So under the interim budget of 2024, the PM Kisan Samman Yojana provided crop insurance for over 4 crore farmers. Another financial instrument to protect farmers against adverse weather conditions is the weather indexed insurance policy. It is drawn from the weather risk index, which is based on historical data on weather patterns. So this can be a fiscally prudent and sustainable alternative to compensate for evaluated crop yield loss due to weather deviation rather than crop damage. Unlike traditional insurance, this method eliminates the need for extensive loss assessment and quantification, resulting in lower administrative costs and potentially reduced premiums. So let's see what are the possible avenues for market expansion. Parametric insurance, which like indexed insurance policies, is paid out immediately when a predefined set of parameters is met, is being experimented by the state and central governments. In Kerala, the State Cooperative Milk Marketing Federation has also introduced parametric insurance against heat stress. Countrywide parametric policies directly linking the beneficiaries' accounts to the insurer can expedite the payout process and limit the economic cost in the aftermath of any climate disaster. So beyond the traditional crop insurance segment, the Indian insurance market should diversify into other segments too. For low income individuals and households, micro level insurance can be useful to secure diverse risk in exchange for a small payment of premium. These can cover for death and diseases, loss of small scale assets, livestock, etc., caused due to climate change induced natural disasters. So national or regional governments and large entities can be covered at the macro level under the sovereign insurance. Now, sovereign insurance is a financial strategy governments use to manage large scale risk. So, in addition to climate insurance, there is need for other risk hedging mechanisms such as natural resources derivatives, which allow the contract buyers to safeguard their positions in the physical market. So, Ghosh in 2022 made the case for a water future exchange in India, given its acute water availability risk. A water availability index is proposed to compensate for the absence of physical water market in India. Any stakeholder can hedge their future position by holding an opposite stance in the future market, ensuring themselves against possible risk, given that basis risk is limited. So this would serve the same purpose as an insurance policy, but liquid markets would enable faster settlement via immediate squaring off of positions. Now, climate risk insurance can indirectly promote resilient investment by the insurer, assessing any project or venture for its riskiness. The insurance company can change higher premiums for projects that do not adopt sustainable and climate risk adaptable strategies. So this will accelerate the adoption of greener, sustainable and climate conscious methods. The creation of a climate insurance market in India with appropriate regulations can reduce asymmetries, lower transaction costs and facilitate a green transition through differentiated premium costs. This will eventually create a market signaling mechanism where sustainable practices receive higher preferences from investors. The continuous public collaboration, aggressive research and development, and financial innovation will be the key to an efficient climate risk hedging mechanism. But climate change remains a critical issue for the insurance industry in 2024. The increasing frequency and severity of climate-related natural disasters is having a significant impact on physical risk exposures and the increasing protection gap. Adding to the pressure, climate change litigation over the insurance of non-renewable energy is on the rise, and insurers are becoming the focus of various environmental campaign groups' protest too. So, as a regulatory priority, it is well known that the insurance sector is very well positioned and highly incentivized in relation to climate change mitigation and adaptation for two reasons. The associated risk affects both assets and liabilities of the insurance balance sheet. Then insurers have decades of expertise in extreme risk pooling, which is critical in relation to the management and mitigation of the catastrophic effects that arises as a result of climate change. However, a response by the insurance industry alone is unlikely to be enough to mitigate the impacts of climate change on the global economy, with industry leaders advocating the need for public assistance as systematic perils surpass the capacity of the insurance industry alone. So while there are many steps that insurance can take in relation to climate adaptation and mitigation, a collaborative effort between the private and public sector, including regulators, governments, and policymakers, is fundamental to respond effectively to the increasing impacts of climate change and to prevent both systematic and isolated instances of market failures. This message was strongly emphasized at the UN Climate Change Conference, COP28 in 2023. So we believe that the first step in achieving this lies in a comprehensive understanding of the most significant issues relating to climate change. Vulnerable communities in developing countries such as India bear the brunt of the effects of climate change. But a growing insurance coverage gap is preventing many of these people from protecting their livelihoods from extreme weather events and climate change. So, to help build climate resilience, insurers must work with policymakers and the stakeholders to advance the necessary products and partnerships that direct capital towards adaptation and resilience intervention. Insurers often respond to these climate driven financial risks by withdrawing coverage from exposed markets, raising premiums, and existing risk prone communities. At the same time, as insurance rates increases, people forego coverages. This not only leaves them vulnerable to climate perils but also drives prices even higher as the number of people paying premiums and sharing risk shrinks. So the perfect storm makes it more difficult for people in these vulnerable communities to get insurance. This prevents them from accessing key services such as mortgages, which encourages climate migration and drags down microeconomic stability and growth. So India has seen unparalleled growth and development in the recent decades, but risk losing ground due to heightened exposure to climate perils, including heat waves, floods, and earthquakes. So it has endured a scorching summer this year with capital city Delhi experiencing the country's highest ever recorded temperature of 49.9 degrees Celsius. That's 121.8 Fahrenheit. This heat wave caused school closures in several states while local governments sent out heat alerts to warn people to stay inside. Even so, dozens of outdoor poll workers died while working during this year's election. So the impact of extreme climate events in India touches on nearly every aspect of its economy and society, but is more pronounced in particularly exposed sectors such as agriculture, which comprises 15% of India's GDP and employs around 40% of its populations, 70% among its rural households. So between 215 and 221, India lost 33.9 million hectares of crop due to excess rains and an additional 35 million hectares due to drought. So several Indian sectors including agriculture suffered $159 billion in economic losses in 2021 due to lost working hours from extreme climate impacts. So by 2030, India is projected to see a substantial 5.8% decline in working hours, equivalent to 34 million full-time jobs due to heat stress. These numbers are likely to increase as climate change continues. If, as expected, 45 million people are forced to migrate from their homes by 2050 as a result of climate change, this displacement would have cascading effects on local economies, for example, by reducing tax revenues. So in India, some of the most climatically vulnerable and hardest hit areas are also the poorest. Communities living in coastal area and hills belong to one of the most economically compromised and climatically exposed social groups in India. So extreme weather events affect the economy in two stages: the initial damage to human and physical capital and the subsequent loss of productivity due to efforts directed towards reconstruction. So one way to ensure the timely, need-based and transparent disbursement of reconstruction fund is by roping in dedicated climate insurance. Climate insurance can pay out claims to insurers in the event of a natural disasters. Thank you very much.